Charlie, what could Facebook have done to avoid these post-IPO legal problems?
Right. Well, that's a great question. I'm sure it's one that the board and a lot of other folks are scratching their heads over, especially, those of us who really care about the fact that the IPO window just reopened for Silicon Valley companies. And there are a number of companies, as you know, that are hoping that they can go public and continue sort of the positive momentum that we've had in at least the last 6 months or so with LinkedIn and other companies that have gone public successfully. So what could they have done differently? Well, securities laws, Cory, as you know, are all about disclosure. So it's sort of what you say and when you say it, all the information that's material. In this case, by our count, there are about 17 of these suits so far. There may be more.
Right.
About 17 of these suits, they're all saying basically the same thing, that Facebook neglected to make public information that was material to the company.
This will be interesting to see because, from my perspective, the last Facebook amendment had an important amendment.
Right.
And it was even talking about the current quarter, which is not clear to me that they're required to do because the quarter wasn't ended. And they said the trend that we've seen has continued, that being about we're not getting, we're seeing not as many ads for our new users.
Yeah, slowdown in growth.
And they put it in and it was a weird thing to add to an S1 because I remember seeing it in the S1 amendment when it filed. We reported it on Bloomberg West, so our viewers got the benefit of that information. So if that's the
But you know what these
lawsuits?
Well, these lawsuits are actually alleging that there were omissions that were not in the offering document.
Right.
And so that remains to be seen.
But they don't seem, the few complaints I've read don't seem to know. There's like, I think someone told somebody something, I don't know what you said, so let's see everything you told everyone.
Yeah, and that selective disclosure is part of the process. And so when you go on the roadshow, you're by definition going to be saying some things to some investors that you may not have put in the offering doc or may not be available to others. So that's all going to remain to be seen. But I'll bet, to go back to your original question, that there are some lessons that we can all learn, those of us who really want to see Silicon Valley companies access public markets. There are lessons that we can learn and that the Facebook board, I'm sure, is thinking a lot about in terms of that selective disclosure and should they have perhaps been even more public about
I think they were very public,
Yeah.
So, all right, so we've seen this process, you know this process, I know this process.
Right.
Securities law is, this is a shocker, headline here, not black and white always.
Right.
And so is the roadshow an inherent violation of securities law?
Yeah.
Isn't the selective disclosure, so should roadshows end?
Yeah, that's the question. So, folks who know a lot more than me about this, like John Coffey, for example, who sort of wrote the book on securities law.
John Coffey, professor at Columbia Law, an expert in securities law, an expert on this whole process.
Exactly right. He's brought that exact point up before, which is, look, these by definition, the roadshow is going to lead to selective disclosure. I think you're really onto something. It's a great idea. We have YouTube now. We have a lot of ways, and Mark Zuckerberg Zuck put out a video, maybe using that as more of a way to do disclosure than the traditional old roadshow where everybody is going to get the same information. That could be a way to go.
When I was briefly a professional investor, the roadshow was a really great source of information at a time where you could get a little candor, not inside information, but candor from a CEO saying, how's this business work? How does this company function? And get a little color out of that. But the fact that it wasn't public meant that, I'd been a journalist, now I was managing money, I thought, wow, this is great. Because this guy knows that what he says to me, he's saying to me and everyone else in the room. It's a legal and fair disclosure, but I'm getting a tenor that this guy might not give in a TV interview or in a magazine interview.
That was in a more closed world, though.
It wasn't that long ago.
It wasn't that long ago. I grew up in that world as well. But that was a different world. Now, I mean, look at the Jobs Act. It's about crowdfunding. So we're sort of at this time of deregulation. The Jobs Act reducing Sarbanes-Oxley requirements for companies.
Gutting, I would say, but yeah.
Okay, well, you'll say gutting. I'll say relaxing Sarbanes-Oxley requirements. One of the big ones, the requirement that an auditor would have to sign off on your internal controls. If you have less than $1 billion of revenue, you don't have to have that anymore. So a lot of us in Silicon Valley think that's a positive move to help in a recessionary time. But guess what? You can't have it both ways. Then you have to come up with some other new ways to get disclosure. You have to have more disclosure, and you have to be able to live in an environment where those lawsuits are out there. 17 filed, like I said at the beginning, against Facebook already. So we're going to have to figure out how we take these companies public in a way that sure takes advantage of some of the relaxed disclosure requirements, but also doesn't set the companies up for lawsuits like this.